Hey everybody, it's Chris Kirkpatrick with Life 180, and I am here today with Matt Porcaro from the 203k Way to do a conversation about how people can get into real estate utilizing, I think, a very little known strategy, leveraging 203k loans. And I'm going to be straight up with you. I don't really know a whole lot about this quite yet. Matt and I are actually in a mastermind together. That's how I kind of was exposed to this idea. I think a lot of people have heard the term house hacking and stuff of that nature, but I'm really excited to get into this because I know a lot of people that follow this channel are really interested in, leveraging real estate, getting into real estate. And I know also that it can be really hard to kind of pierce that veil and get your first property and get the ball rolling ultimately. And Matt's focus, actually, I'm going to let you kind of explain your focus and introduce yourself, Matt. But I'm excited to get into this because, like I said, I don't know a lot about it. So I'm excited to really have this be conversational and kind of have you share your story, how you found it, who do you think this is good for, and give a little backstory and go into everything a little bit.
Sure. Yeah, man. So appreciate you bringing me on. Like you said, we're in a mastermind together, and that's been immensely valuable in every aspect of my life and business, not only in real estate, but everything. But it's cool to have this opportunity to talk to your audience about this thing because at the end of the day, like you said, the 203k loan doesn't really roll off the tongue. It's something that maybe isn't as known as I personally think it should be.
Yeah.
The way I found it was very kind of accidentally. And I could go a little bit more into really how I found that. Start all the way back growing up when, got brought up in a blue collar family. My dad owned his own business, very small business. And I think we were just kind of chatting a little bit before the call, just repeating the business the same year after year, never really seeing growth. He's an excellent, he's in general contracting business. He's a carpenter, excellent at what he does, like a tremendous tradesman. But maybe some of you guys that are listening now have heard of the book called The E-Myth. The E-Myth being is if you're if you practice a certain, let's say you're a baker, you're an amazing baker, but the second you go to be a business owner, you now become an accountant, you now become a manager, you now become a landlord, you now become, you have to know about how to market and you become all these things. And for many people, that's a very hard ask, right? That's a very big pill to swallow. So, that was kind of one of the things that kind of drove me into wanting to see how I could do more, how I can kind of crack the code on some of these things with running a business, because, the reality of it was, I went to school, my parents growing up, they always wanted me to not do what they did, right? They thought owning their own business was, just tremendously hard. And we saw great times. We weren't poor by any means, but there were definitely tough times during like the recessions and, he's a, general contracting, construction, very cyclical. And, there were times when we couldn't keep the electric on. And, that was very transparent in my household. They didn't keep that a secret. And I knew very, very easily when my dad wasn't doing well with work and it weighed down on us. And that's really my why. Like growing up, I saw just kind of that volatility with money. And that was something that really always just resonated with me. And from an early age, I just wanted to know, like, how do I leverage myself and not have that? So, in conventional wisdom, my parents told me, well, you go to college, you get a good job, and you work for somebody else, right? To them, that was the dream. That's the Shangri-La. They think that the grass is always greener on the other side, like everybody else. And they think that getting a paycheck every week, a stable income, which they never had, is the end goal, right? And like, as I said, the grass is always greener, right? There's times when you feel like, man, I wish I had a 9 to 5, but then there's also times when you're like, man, I wish I had some freedom and I can go, do what I want. So, this is all kind of a culmination of what kind of pushed me down that path. And I went to college, I'm an electrical engineer by trade. I was trying to do everything right. You know what I mean? Like got a good job, got a demanding job and a job that was in high demand rather. And, graduated. And again, I grew up in this environment where I was around, if my dad did want to go on vacation, or when we did go away and when things were good, we just got to go on vacation. You know what I mean? And then I entered the job world and I get 2 weeks of vacation a year. And and I'm being told, I can't go see my family. And, and growing up, my dad being able to hang out with us during Christmas week, and like me not being able to celebrate Christmas anymore. So it was just like those things where you see the grass isn't really greener. And listen, I got into the job force and I liked what I did, but I just very quickly realized two things. Number one, this wasn't the level of freedom that I was looking for. And number two, this isn't also how you get rich, right? Like this isn't how you kind of get rid of money woes. One of the biggest things for me was like when I first started, I was working at like a union company, and, at great job security, but also great job security. So, I came in with that hard work ethic, like from my dad growing up, just work your butt off, finish what you start. And I just remember like doing work and like trying to finish something up by the next day. And the guy's like, you can just finish it tomorrow. I'm like, I guess I could. I'm coming back tomorrow. But like, I just wanted to finish what I started. Like they were big on clocking in and clocking out at 9 o'clock, back then it was 7 a.m. to 3 p.m.
Yeah.
So it was like clock in, clock out. The guy next to me is making the same or more money and not nearly working nearly as hard as I was. And it's just like, working hard might not be the best way to climb the ladder. And it was just like all these like things. So it was ironic that very quickly into my career, I wanted to make a change. And that led me down this rabbit hole of like just trying to look for other ways to make money. And, I like to say all the time, I fell for every trick in the book, right? I fell for all like the make money quick online things. I did affiliate marketing. I tried trading penny stocks. I tried trading options. I tried creating other online businesses, e-commerce. I tried a whole bunch of things. Right. And this kind of all spawned from, as I was going down this path, I would hear this one book that I'm sure called Rich Dad, Poor Dad, thrown around a lot. And that being kind of a hallmark book for a lot of people, because for people like me, conventional wisdom, growing up in a household that doesn't know how to manage money, this is conventional wisdom. This is what's told across the world. It's still being told today. You know what I mean? There's some disruption now, like entrepreneurship is just now kind of becoming cool. Yeah. But back, less than 10 years ago, I mean, the whole thing was go to college, get a job. We're seeing that's kind of blowing up in a lot of the millennial faces right now. And, reading Rich Dad, Poor Dad kind of was like, oh, this is how people get rich. You know what I mean? Like they own assets, they make their money work for them. Like seeing everything my dad didn't do. When my dad got a big job or he did a lot of money, we went on a vacation and he bought a car. You know what I mean? He wasn't buying assets. And it's a huge, for people that get brought up in an environment where this isn't like a norm, like for me, this is like mind blowing. You know what I mean? Like this is like this is a really life-changing thing. So one of the big things in there was like owning real estate. Like more millionaires are created with real estate than anything else. And I knew that. But at the end of the day, I was like, owning real estate. I'm like, I would be lucky if I bought a house, like one house. I couldn't imagine owning multiple. I always say like, I thought right from the beginning, like, oh, okay, Rich Dad, Poor Dad, like that's cool. But like, yeah, right. Like this is only for like rich old people that have more money, like a huge retirement savings, and they go and start buying real estate. But like for a 22-year-old or 23-year-old, I'd be lucky in my market in New York to ever buy a house. Right. Mm-hmm. So lo and behold, I went down, I knew real estate was kind of the thing. And I went down a lot of different rabbit holes of real estate. And there's a lot of stuff out there that's like, hey, you can, the infomercial things like, hey, you can get started with real estate with no money, no credit, no pulse. Like you don't need to do any work. You can just open up this program and we'll give you tons of deals and everything. And I fell for all of it. Again, I'm super gullible. And I went down those paths. And one of the things that's in there, and I don't want to go too deep on this with the wholesaling, but one of the main methods that you may have heard of, or anyone listening may have heard of, is called wholesaling. Wholesaling is basically, they call it real estate investing, but it's really not. You're basically finding deals for people and then getting like a finder's fee for those deals. it's very alluring. It's very sexy. It's very, rags to riches type stories are across the board on that. But I found out very quickly, especially in my market, it's an extremely high barrier of entry, a low barrier of entry, but very high competition. And it's just very hard to break into it. And what's funny about it is they tell you, it requires no money. But then once you get into the programs or once you start reading, they're like, well, it does require no money if you have nothing but time and you could just spend hours a day door knocking on houses. But I still had a full-time
driving
job.
Around and all that.
Yeah. And I still had a full-time job. They told me I could do this with the job. But so like, it's the juice is the worth the squeeze type of thing. And they're like, well, we have this program or we have these mailer things and you can send out, and it's $1 a mailer, but you have to send out 10,000 mailers per month in order to see a baseline. I'm like, I don't have 10 grand a month. You know what I mean?
Yeah, totally.
So I went down there and I'm like, oh man, I don't know, this doesn't work. And I tried it, man. I tried it for like 2 straight years. I really did try it and I didn't even get a deal. I got close on 2 and then that was it. And I was really frustrated. And it was like, I'm like, man, like what, like, I know now I'm down the real estate game. Like I believe real estate. I'm sold on it. Like I want to do this, but like, I just didn't get it. So now I'm just looking at anything real estate related, any way I can start up. Tried a bunch of different mentorship programs, and then finally, like I went to this one program that was given by the person that ran my local real estate investment association. Okay. So I eventually found my local RIA group, they call it, and they're a great resource. It's another place where there's a lot of upsells and things like that. But at the end of the day, I figured like, okay, my market's really tough, right? I mean, I was in Long Island, New York, suburb of New York City, one of the highest costs of living in the US, very competitive. Everyone thinks their market is competitive. Let's put it that way. But this market is very competitive and has huge, very high tax rates, which squeeze a lot of the little guys out. So I went here. I'm like, maybe they understand the nuance in this market, right? So, I joined their program. They had like their own kind of mentorship program, and it was not cheap. It was definitely a couple thousand, 5, 6, 7,000. Me and my dad did it together, and I joined the program, and I get in it, and I'm like, this is everything I've been learning for the last 3 years. What the hell, man? Like, this is the same stuff. Like, this is in books that I've read. This is in courses that I've read. Everything like that. So, I pull the lady to the side one day and I tell her, hey, listen, I've been trying this for a couple of years now, right? Like I'm really trying to do this right. And like, I'm going in this program, and no offense to you, like the program's great, the content's great, but like, I've seen this all before. Like, I just want to know. She's very successful, wildly successful. She's like a super mom, has 8 kids and like has like 500 houses, runs the local RIA, like she all-star. Right. And I never undermine that, Yeah. And I said, if you're in my position, I'm like, listen, I got a couple grand in the bank. Like, I don't have a lot of big savings at all. Like, this is the most I've done. I've been trying to save. If you could do this all over, like if you could start over again, like, and you were in my position, 20 something years old, 23, 24 years old, like, what would you do? Like, wholesaling's tough. That's hard. She said, well, there's something called a 203k loan. And what this loan allows you to do is it allows you to purchase a property and also finance the renovation cost of that property into the loan amount. So it's an owner occupant loan, which means you have to buy the property. But what's great about owner occupant loans is you have super low down payment, only 3.5% down out of pocket, which is very attainable for anybody. And you can wrap in all the renovation costs into the loan. So you're not paying out of pocket any renovation costs, literally 3.5% down and some closing costs. But I talk about ways to negotiate around that. That's all you really need. And she said, listen, look for a beat up deal, just the same way you normally would, but then go in, you can probably sell it. She's like, you have a couple grand. If you find like a really beat up house, you could probably get in for, $9,000, $10,000. So I'm like, okay, wow, this sounds really awesome. So I'm like, how come I've never heard of this before? Okay. Basically she's like, go do a live and flip. Right. So she said, find one of these houses. Kind of like you said in the beginning, a house hacking concept. So basically she's like, find one of these houses, go renovate it. You have to live in it for a little while. That's kind of the goal of this. But if you leverage this loan correctly, you can go in, live in it, you know, and I was going to like live in the basement and rent out the upstairs. Right. And then she said, listen, once you're done, you know, you live in it for a little while, you refinance it, you take some of that equity that you built when you did the renovation and you go repeat the process. And that'll be your nest egg for your future deals. So I was so gung ho on this, man. I went home. I was like, this is going to be the coolest thing. I'm like, how come I've never heard of this, but whatever. I Googled everything and there's like no information about it, like none. And I'm like, what the hell, man? Like, I'm just kind of like losing it. I'm like, I don't get it. Like, this sounds like such an amazing thing. Like, why does nobody put any information about it out there?
Totally.
So lo and behold, like fast forward some time, I thought about it. It was one of those things. I'm ADD and I like put it on the back burner, you know, went back to work for a while and like kept saving money. Like I knew I was saving money. Like I was getting closer to getting married. I was saving for a ring. I was saving for the future. Right. And I finally was getting a little bit of a nest egg. And one day, and this is, if there's one takeaway from this, is like just taking action is like the best thing you can ever do. Because one day I had a little spark in my head and I was like, let me just call my family friend, the only mortgage broker I knew, only mortgage person I knew. And I'm like, let me call him. Let me ask him about this 203k loan. I was like, it was like an epiphany. I'm like, I have a little bit of money. Like, let me just ask him if he even knows about this thing.
Sure.
Calls up. He's a family friend of mine. He's my cousin's best friend from years. I've known him since I was a kid. And he's a typical New Yorker fast talker. And he's like, yo, what's up, man? Good to hear from you. Blah, blah, blah. I'm like, hey, have you ever heard of the 203k loan? He's like, yeah, dude, like that would be the perfect thing for you. What are you looking to do? I was like, yeah, I'm just like looking to buy a house and like do a live-in flip on it, build some equity. And like, I don't know. I figured he's like, yeah, man, like we're going to get you pre-approved. And like, before I knew it, he's like super fast talker. I'm like giving him my tax returns. I'm giving him everything. I'm like giving him my social. And honest to God, I say, and we can get a little bit more into like, a little deeper on like the actual strategy and the tactics with the 203k. But the reality is probably I wouldn't have done it if he didn't push me over that edge. And that's why like taking that little step did so much for me, because I took a little step of like just kind of asking about it. And before I knew, I was pushed out of my comfort zone, but ultimately into something that really changed my life. And, before I knew it, I was pre-approved for this thing.
That's awesome.
And I'm like, oh, crap. Okay, now it's time. Like I got to really like start looking for deals and stuff. And that became the deal finding process. And, we could get more into that. I don't want to go too crazy. I want your questions as well about it. But ultimately what happened was it pushed me down this rabbit hole. And it was, the reality was there really wasn't much information on it. All I knew were a couple things. All I knew was this sounded like a great program. It sounded too good to be true even. I knew that I can buy, a beat up house with it. And I knew that I could do a live-in flip on it basically. And I knew I didn't need that much out of pocket. I knew this was probably all I had money-wise, but I knew if it was going to be able to get me that first deal, it was really going to be an important thing for me. And that's what I did. And then, it all unfolds from there. But I would love to know more about what your questions are about the process.
Yeah, no, I think I love that story. So I guess my question would be is like, I mean, I'm not a candidate for this. I've already got a home. I live in it. I couldn't go live in a flip. But so it seems like to me that this is absolutely for somebody who is maybe younger, single, or small family, willing to live in a little bit of a kind of a chaotic environment for a period of time, just to kind of like make that sacrifice to kind of break into the real estate world. Because from what I understand, if it's an FHA loan, you're not going to need to put as much down on the property. You mentioned already you can finance the construction costs or the renovation costs into the loan. So can you kind of like break down like what, in your opinion, like what is it? What is this program like? What's the avatar of the person who like does this the most? You know what I mean?
Absolutely. Yeah, man. So listen, I think it's safe to say that it really depends on people's comfort level, right? So yeah, in general, like I found that it caters to, the young professional, the younger, it's still, and young is relative these days, right? It's maybe a professional that's been renting for the last couple of years. For me, I was still living with my parents at that point. And just looking to make that first move and looking to make that next deal, but understanding that, the American dream and keeping up with the Joneses really isn't the way. And a lot of your audience, I'm sure, has that, like the financially,
Totally.
the people that are really looking for financial independence, really looking to make a great decision financially. You know what I mean? In Rich Dad Poor Dad, he talks about how like your first home is a liability, right? It's a house you paint on with money. I like a house, like a house is an empty canvas that you paint on with money, right? It's not as much of an asset because it's not paying you. You're not making an investment. I'm sure as many of you know, if you ever look at a truth in lending statement, right? When you buy a house with a 30-year mortgage, over time, you are paying double what that house is actually worth when you purchase it. So if you buy a house for $500,000 over the course of 30 years, if you look at your truth in lending statement and you see how much you're making in monthly payments over the next 30 years, you're actually paying double for your house. Now, listen, that's great. But the whole thing with me was like, I wanted to just see how I could leverage this to make sure, because it is a big purchase, but I don't want to just fall into the trap of overpaying for something or doing something wrong in that regard. So
Sure.
That's like kind of the long answer. The short answer is, for doing a live-in flip type strategy or using one of these renovation loans, there's a couple different options for you. The 203k loan is the FHA loan that requires owner occupancy. And what is cool about it as well, and we'll get into a little more in the second, which was what I did with my property, was FHA loans allow you to buy up to 4 units with only still 3.5% down. So what I did was add in that house hacking concept, right? So what I did was I bought a 2-family house, moved in, and then had my other tenant pretty much pay the bulk of the mortgage. So besides the down payment, like I really didn't come out of pocket with much because my tenants were always paying it. Now I have since moved out of that property, and that property actually cash flows me $2,000 a month since I moved out because I now rent out both. This isn't really, this is for the person that maybe isn't looking for their forever home right now as well, although as you could use it for your forever home. But it's a stepping stone into starting your real estate journey. Another cool program that's out there is called the Home Style Loan. The Home Style Loan is very similar to the 203k. It's basically considered the conventional mortgage of, there's FHA, usually mortgages are FHA or conventional. Conventional means it's not a federally backed loan. It's Fannie Mae, so it's still kind of federal, but at the end of the day, it's considered, it needs it's a little more stringent on the requirements. But one cool thing about the Home Style Loan is Home Style Loans actually allow you to buy up to a couple. You're limited to like 4, but you're able to buy investment properties and use the renovation mortgage, same type of thing. Still pretty low down payment, 15% down, which is way lower than if you went to a bank and tried to do it the conventional way for a rental property. And you don't have to occupy the property, and it's 15% out of pocket for the renovation plus the purchase price. And that is a great way for people that, even like yourself, that already have a property that you want to do another one. You can use a loan like that, and you still don't really need to come out that with much. The only caveat to that is that it only has to be a single family. It doesn't let you do a multifamily.
Oh, it doesn't let you do multifamily. So, and that's called the home style
loan. Yep. A Fannie Mae home style. Yep.
And so you can take that loan, and you can also finance in the renovation costs in that as well.
Oh yeah. Yep. Really? Yep. It's a renovation loan. Yep. There's a lot of different flavors of those loans out there, but the 203k and the home style are the big guys.
Are the two big players. Okay.
Yep.
So when it comes to the 203k then, and you look at, I don't know, just like all the different options and moving parts, the way I would look at it, like if I were going back to my 30-year-old self before I had kids, even being married, my wife would have totally been into this had we known about it.
I know, that's the sad part.
I mean,
but that's why we're doing this, right? To get the word out there.
Yeah, totally, man. Like, so I'm looking at it like, like, I'm just thinking of the strategy. So I just want to like spitball this with you for a second, like get your thoughts on it. So like, if I were able to go, well, first of all, is there a maximum amount of a loan that you can get for the 203k?
So good question. So the FHA, the 203k follows FHA guidelines. Okay. So Yes. So there is maximum loan amounts, maximum FHA loan amounts in every market. It
Okay.
really is market dependent. So in high cost of living areas, it scales,
It's high.
right?
Okay.
So I mean, for example, like in New York, you could buy a fourplex up to like 1.9 million or something crazy. Yeah. I mean,
What?
it gets high. Yeah. I mean,
Okay. Okay. So it
so
really is depends on where you live.
yes. And what I will say is in general, as long as you're not buying like a mansion, in
You're going to be
general,
okay.
if you're buying like a relatively like, you know, a relatively average single family home, you're probably more limited by your debt to income ratio or
Okay.
what you would qualify for,
Sure.
for your monthly payment versus, what the loan limits are. In general, I haven't found too many people that hit that loan limit mark.
Okay. So the reality is if you're using this strategy and you're looking for those diamonds in the rough, so to speak, where you're trying to be able to find houses that are great value that can be fixed up, that you can kind of create equity by fixing them up and financing the renovations into the mortgage itself, then
Yep.
you're probably not going to have problems anyway.
Yeah, I mean, and that's what it comes down to, right? So, the culmination of what I've created, right? This whole
Mhm.
the 203k way strategy, as I call it. This is something that I kind of figured out as I went and figured out as I learned the strategy, but then also used and leveraged it with real estate investing tactics, right? So at the end of the day, this loan is like literally to give people the opportunity to purchase a house that might not be move-in ready and
Mhm.
not lose out on that potential deal because of, they want to buy a house from a seller. How many times have you heard maybe in the mortgage business where someone wanted to buy a house, but the inspection comes back and like there's a bad leak in the basement and then the deal
Totally.
falls through? The
Mhm.
203k loan is great for just first-time home buyers. I'm telling you, right, we were talking about this now. I'm going to do another one right now for my forever home. I'm going to buy a beat up property and I'm going to renovate it and make it look like the way I want it and keep it long
Okay.
term. It doesn't need to be like a full on, real estate investment. But what I wanted to do on this first one was I wanted to leverage the loan and still follow basically the general strategies of real estate investing, right? So basically I wanted to be all in for a significant amount less than what it's going to be worth when it's done. So
Mhm.
that's really what I went for. I was looking for, well, honestly, I could only afford like the most ugliest beat up crappy houses in my market because at the
Nice.
end of the day, I still was only one person on
Yeah.
a loan where, a lot of people in my market, they depend on two incomes. They depend on like a husband and wife or two
Sure.
partners working together to be able to afford this place to live, So
Yep.
I went into this just knowing that. And I looked for pretty much the most beat up and dilapidated stuff out there. And eventually what I fell on was a 2-family house, which was something that I was looking for. And I placed a couple offers on one and finally found one that was honestly I was reluctant to do. It was an old crack house. Literally, they used to sell drugs out of the front window, but they evicted everybody. They condemned it almost. And
Wow.
it was next door to, it was right down the block from train tracks, next door to a church. And the front yard is essentially a row of bars and a huge parking lot. So
Nice.
the location was not the most opportune location, but I did know there was enough commerce in the area. It was close to trains. It would get tenants. And I knew that it was good enough for me. And when I ran the numbers, I did see that at the end of the day, it was really beat up. It needed an ample amount of work, but when it would be done, it would be worth significantly more than what I had put into it. So what ended up happening was this property in particular, which is the one I did it. I analyzed the deal. I ended up picking it up for 270,000.
Wow.
It needed about $80,000 of work. So we put in, so all in my 203k loan was 350,000. Okay.
Cool.
When I was done with the renovation, and we can go more into that, on another episode or anything
Yeah.
like that. But
Yeah.
when all was said and done, I got it reappraised, and it reappraised for 480,000.
Wow.
So
So
I
you made
had built
130.
130k of equity in 8 months with a $10,000 down payment. So I knew that I followed the right strategy. And when people started finding out how little I put down, And then when you really kind of ultimately see the power of this leverage, I mean, it's like a 4,000% ROI. I don't know. It's
That's
like an insane ROI, right?
amazing.
But
Yeah.
the point I'm trying to make is if you have the ability to, or you're willing to make make that commitment of kind of not maybe buying that first house as your forever house, but maybe that being the springboard to get to your dream home, and having that house be the first asset, not a liability, and have it build a lot of equity, because that equity I now use in my flipping business, right? I use it in my investing business.
Totally.
I tap into that equity all the time for future deals. So that's the culmination of the way this 203k strategy came from it. It's like using this loan as a tactic, a really good way, a really accessible way for average people to get into this loan, but then really use it and squeeze the sponge, so to speak, and milk out as much value out of it as possible. And that's the way you do it, is basically using this loan, but looking at through like a fix and flip or an investor's lens.
Dude, I think that's amazing. So like where I was kind of going earlier too, before I kind of got sidetracked with asking these other questions, is like, if I were back to my 30-year-old self, 29-year-old self, like the best way to do this would be to find the best like quadplex and possible, because they're probably going to have the best value, the more units, and like get right up to the max. The cost per unit would probably be less on a quadplex and a twoplex or whatever. Yeah. And something that needs work, and you could almost like rent them all out, live in one, fix it up, and then rotate, and then live in it, fix it, rotate, live in it, fix it, rotate, live in it, fix it. And like, since you live in the full building, it doesn't matter which unit you live in out of them, right? Like you could take 4 months or 3 months and dedicate to each unit, right?
Yeah. So, I mean, a perfect example. One of the first guys I kind of mentored through this whole process. He is a young guy, 24 years old. Actually, no, not Arizona, New Mexico. Okay. But he was a teacher's assistant, very low income, like for what it was worth. But he wanted to do this. And he just had the best attitude. And I took him under my wing, and we were working together. And mortgage lenders across the board were like, dude, you don't make enough money. Like, you're definitely going to be challenged here. He's like, I don't care. I'll do whatever I have to do. And one of the ways he did that was he bought a quadplex. Now, here's one of the cool things about buying small multifamilies. When you get pre-approved for a loan, you're able to forecast that future rental income into your new income, right? Yeah. So on his own, he could not afford a quadplex. He just couldn't. But when you take into account that he'd be living in one of the units and renting out the other 3, they're able to take a portion of those proceeds. It's like 75% they qualify of the income, right? Yep. So 75% of that income, all of a sudden, he went from a borrower that didn't have a shot to being one that could absolutely afford this. And actually, I mean, he cash flows, he picked it up, lived in one unit. So he's living rent-free, mortgage-free, and still making $1,200 a month in cash flow. So he's not only living for free, but he moved out and he went the quadplex route. So that's one of the cool things. And honestly, that's the way I got into my property. As it turns out, that $270,000, which was like probably one of the cheapest in the market, was still too high for my income. I was just, I had entry level income. I made good money, but not like great. Sure. And the reality was, the only way I was going to afford the mortgage payment, it was like a $3,000 a month mortgage payment. The only way I was going to be able to do it was by factoring in that other unit and being able to use that. So that's the beauty of multifamily, right? So what's cool about multifamily, again, is like you can get in, rent out all the, renovate all those units, get everything up to snuff, move in, live in the one unit to get the qualification. And then listen, I'm sure the average person maybe doesn't want to live in a quadplex their whole life, but maybe you do. Maybe you like to live for free. Maybe that's more important for you. But a year or two later, you move out, you move on to the next thing, you rent all that out, and then it's strictly cash flow.
Well, yeah, you could choose between like living in an apartment unit surrounded by a bunch of people, or doing that and actually building something, substantial, and that would create a ton of opportunity. Like, yeah, that's man, are there any opportunities to do that in the conventional space? From a loan perspective, to be able to like finance the loans in, because you mentioned the home style loan, but you can only do that on single family.
So yeah, I mean, so listen, here's the thing with the home style loan, you are able to, you're able to buy up to a fourplex. Um, the caveat with the home style is better for single family. If you want to do like a fix and flip, a live in flip, as they call it, because it's 3% down. Actually, it's slightly less than the FHA if you're doing single family.
Really?
Yeah. But for every unit that gets added on, you need more out of pocket. Now, here's the thing, man. Like, it's
Okay.
still a great deal. If you have that initial capital, like
Sure.
you can still do these home style loans. It goes up. So a two family, I think, is like 10% down they look for. And then a 3 to 4 unit, it's like 20 to 25% down they look for,
Okay.
which is on par with pretty much what a bank looks for on an
It's pretty
investment property.
standard, but if they're going to,
Yeah.
yeah, I mean, so it basically ends up being like conventional loan, like expectations as far as down payments, right? Like,
Right.
however, you're able to finance in the renovation costs.
Right. And that's where the real value comes in. You know, it's making sure that you do a good, and that's the importance on really looking for stuff that's pretty beat up, right? The more beat up that it is, the more equity potential that's there. And you know, there's I was able to do both. The duplex was kind of the sweet spot.
Yep.
I was able to build in enough value to really score on equity, but then on the same time, I was able to live for free, get some cash flow, and then had since moved out and now have it completely cash flow and pay for itself, right?
Yep.
You can do this as a single family and just do a move in and do a live in flip rather.
Sure.
Build up a ton of equity, take out a home equity line of credit and go leverage that into another deal. Now, you know, you maybe only came out of pocket with 10 grand, but now my home equity line of credit opens up 70,000 for me. 70,000 is a much more sizable down payment for a future deal.
Sure.
It's kind of helping you springboard from there.
Well, there's the other element that I look at it because I love cash flow real estate, right? Like that's
yeah, of course we all do. Yeah, that's that's the crown jewel,
right? And so from that perspective, though, couldn't you also get a duplex to a quadplex and do this and live in it for a year, but then when you're done, not sell it, not take like you can cash flow that thing and then just do cash out refi for a percentage to then get your next property without giving up this property, right? Like, I mean,
oh yeah, absolutely. Now the whole thing with the cash out refi is you just want to make sure there's enough equity on the bone, right? So that's kind of the thing. Like as a baseline, I basically preach that you want to make sure that you're building in at least 20% equity into the deal, right?
There's PMI and stuff like that, right?
Right. So PMI, for anybody listening that doesn't know what it is, that's basically the price you pay to being a subprime borrower, meaning you're putting down less than the desired 20% down that banks typically go for. The FHA is the best way I like to explain it is FHA loans are basically all federally backed, but ultimately the Fed basically or not the Fed, but like the federal government has a giant bucket of money that everybody pays into in the form of PMI. So your PMI is basically your insurance payment if someone else with an FHA loan, they default, right? So that's why banks do these loans, because the banks say, hey, listen, bank, if someone defaults, we have a big pile of money and we'll pay you out because you took this high risk loan. With the FHA, as soon as you refinance out of that, though, you are no longer part of the FHA club, and you don't have to pay that extra couple $100 for a month. So what I did is when I refinanced out right away, I refinanced out into conventional. I got a little break on my interest rate. And then I also got rid of like about $250 a month of PMI. That's a nice little boost to cash flow when you do that. So really, when you're looking to do any type of these things or a fix and flip, it's also kind of called the Burr method. It's referred to as a lot. You probably know about it. But basically, when you do that refinance, a cash out refinance, or tap into the equity, you just want to make sure that when you do your renovation or when you run your numbers, that it's going to be worth at least 20% more when you're done than what you paid to get into it.
Yep. No, that's amazing. Well, I'll tell you what, man, I'm really excited about this. I have like 1,000 questions. We are coming up on time for this interview. So like what I want to do for people is let them know, like, I know my intrigue has been built during this conversation so far. And thanks for sharing your story. And so if anybody out there is watching this and wants to get a hold of Matt and talk about doing this, I'm sure he'd be happy to get on the phone with you. And what I'll do is put a link. I mean, can you explain kind of, I'll put the link down to your site. I know you offer free training. Can you kind of explain how that works and what people can or should expect if they do that?
Sure. So, kind of like we've been getting into, there's a lot of moving parts on this thing, right? And kind of the reality of why this thing isn't that popular is because it does intimidate some people.
Okay.
The reality is if you go through my story, I could share my story on another call with you, but I almost like made every mistake you can make throughout the process, and I still came out. And it was still the best thing I ever did. And
Okay.
you'll probably ask to anyone that has done these things, they'll tell you, there's some bumps in the road, but that's this game. I mean, that's real estate investing.
That's real estate in
101.
general.
Anyone that's telling you that it's easy is blowing smoke up your butt.
Lying.
So, at the end of the day, my whole goal with the 203k way is to take away that veil, kind of open the doors for people, really create based on things that I've learned, based on my networking with people in the industry, really take the veil away and really give a clear and concise step-by-step guide map for people to go and replicate this process and do what I did. Because I just felt like there was a need there. And I felt so many people were asking me, how the heck did you do this? And it culminated into the 203k way. So basically what I did was I put together a 1-hour live training. And it basically goes over what I call like the 3 secrets to really leveraging the 203k loan, right? It's how to leverage the 203k loan and get a high equity, high cash flowing property, just like I did, with only 3.5% down out of pocket. And you can get that free training at the 203kway.com/free training. 203k is the colloquial word, but it's 203k for anybody listening. It's not actually the letter O. But yeah, the 203kway.com/free training. And that's a 1-hour training that's really going to give you a great foundation really to getting started with this if you're interested in trying it yourself.
Beautiful. And I will link that below so people can see that and just click on it so you don't have to worry about, messing it up or anything like that. So,
yep.
And Matt, I tell you what, I'm really excited because I've heard your story. We've talked a bunch, obviously, and I know there's a lot more to this. So if you're game for it, I'd love to have you kind of come back like once a week for the next several weeks and just like talk about this and get deeper into it, because I know the more deeply people dive into this, the more curiosity they're going to have around it and the more interested they're going to be. And I like I said at the beginning, I think this is such an amazing opportunity for people who kind of have that affinity towards real estate to be able to kind of, break through and be able to get their first property. I mean, to be able to get a $400,000 property, here in Chandler, where I live, Arizona, like for $14,000 down would be absolutely insane. If you could find the right opportunity to, build some equity. And the way this market is going right now, holy cow, like if you can get into something and fix it up, and, equity will build faster than ever.
Oh yeah. And this is, I mean, I always say there's never a bad time to buy. There's only, bad deals and good deals in any market cycle. Yes, we're seeing probably one of the hottest markets right now, but I would say it's even more pertinent more than ever to make sure that you're buying correctly and you're not getting emotional in the feeding frenzy. And,
Yeah. And with that though, man, like my wife, runs a real estate team right here in Arizona, and it's insane because like you got all this California money coming in, you have all these people that are just driving this market insane because everybody's trying to get out of California and they're coming here. And the bidding wars, I mean, she had a house the other day, a $320,000 house that was listing price. Somebody offered $50,000 over market value cash.
Oh yeah. You're seeing it happen across the board.
Happening everywhere, right? But the cool part about this is like people want those cookie cutter, move-in ready, whatever houses.
Right.
When you're looking for distressed properties that need some tender loving care and to go in and live in a bit of a mess and rebuild it, there's not going to be the same amount of offers and competition and whatever. So you can still get those good deals if you're willing to work with the right person, and have a realtor who knows how to help you find those opportunities and go out and do the research on your own.
Yeah.
I think it's probably a better opportunity now than ever. Like now that I'm like thinking through it all.
Yeah. Warren Buffett, right? He says, be greedy when others are fearful and fearful when others are greedy. Right. And, people are greedy right now, and it's the time to just be like, maybe I shouldn't feed into buying on emotions. Never a good thing. Okay.
Yeah.
And especially in real estate, especially on asset buying. I mean, you've been seeing it with the stock market lately, people finding out about, Bitcoin way late, and they're all jumping in and piling in late. And usually when you're the last to the party, you're the one that ends up getting burned. So I'm not saying anybody's last to the party. All I'm saying is that don't really buy on emotion or feed into the hype. This is really the more important time than ever to stick to your numbers. And here's the good news for people that are looking to buy undervalued. Maybe not good news. It could be interpreted that way, but we haven't had any foreclosures in the last year. And there's a lot of people that are living for free. And the sad reality is, yes, hopefully mortgage companies do work out deals with people, but it's not going to be all of them by any means. And we're going to see, I don't like predicting, but if history tells us anything, you're going to eventually see a lot of foreclosures, a lot of beat up, distressed houses start trickling back into the market when these eviction moratoriums start coming offline and everything like that. So now more than ever is a good time to start posturing for that and really anticipate that and just make a great decision in a time when people are making pretty emotional and brash decisions.
I love it, man. Well, that's awesome. Well, I look forward to having you back next week if you're game for it. And
yeah, man, let's keep doing it.
That's awesome. So, all right, guys. Well, I hope that helps. If you have any questions, any comments, you can look in the description below. All the links that you'll need will be down there. I'll link up all of Matt's social information, his YouTube channel, his social media handles, that way you can connect with him. Reach out to him, just connect with him. Let him know that you saw him here, and I'm sure he can be a wealth of knowledge to help you kind of get where you want to go and get into your first property, all that stuff. And until next time, I guess we'll see you next week when I have Matt back, and have a blessed, inspirational week. We'll see you then.